Learning objective number 3, adjust the accounts. I'm going to go ahead and stop right here and actually show you. Okay, so let's take a look at what we can refer to as the accounting cycle. The accounting cycle. This is from the beginning to the end, and this is what we're really going to be focusing on over the next two weeks or so, 2 to 3 weeks. The accounting cycle, how it's all going to be recorded through the entire system, starts with the source document. An example of a source document could be an invoice received from a vendor, checks that have been written out. You have the check itself. You can see the check. You'll use that as a source document. An invoice that we send to a customer, receipts that are received, a timesheet that's turned in by an employee. A source document really is evidence that an economic event has occurred. It's evidence that an economic event has occurred. And with that source document, by the way, it doesn't have to be a physical document, it can be an electronic document as well. Once we receive that document, we have a basis to record a journal entry or to record a transaction into the accounting system. Now, the way we record that journal entry is into what we call a book of entry, which is called the journal. And we've already been exposed a little bit to journal entries, but we're going to be exposed to it a lot more over the next week or two. Think of the journal as simply the book of entry. It'll show which accounts are impacted by the transaction and whether there's a debit or credit involved. From there, we take the information that's been entered into the journal and then post it to a ledger. We've talked a little bit about this before in the previous sections. The ledger is simply a book of accounts. And if we have a relatively large book with a sheet dedicated to every account, showing every transaction that's been recorded in the journal and updating the specific accounts and the impact to that account, whether it went up or down, that's what we keep in the ledger. Now, it's difficult for us in a classroom setting to really have a full-blown ledger to manage, but we often use T accounts to represent what's in a ledger. And the T accounts really showing the debits and the credits and the balance associated with each account. Same thing for the ledger. From the ledgers, we then generate what's referred to as a trial balance. And the trial balance is simply a listing of all the accounts, their balances, and whether they are debits or credits. The objective of a trial balance is to confirm that debits equal credits. We learned that in all cases, all debits always equal all credits. There are no exceptions to that rule. The trial balance helps us to confirm that. Now, up until this point, if we think about it from an accounting cycle perspective, we're thinking about the transactions that have already occurred that really just kind of happen automatically. So accounts receivable, we'll issue out invoices, boom, you have a source document, we record the sale. Employees turn in timesheets. We now have a source document that we use to record payroll, and that payroll is entered to a journal. An invoice is received from external parties, from outside. It comes in the mail. Now we have a basis to record a journal. All these things are happening through accounts payable, accounts receivable, payroll. The different areas of the accounting department are processing transactions regularly. It's almost happening in autopilot because, and the example is an accounts receivable clerk may not even understand what's going on with the accounting system. They just know they've got to enter this invoice in this sheet here or into this computer, and then the computer makes sure that the journals are updated and the ledgers are updated. Okay. Same thing with payroll. And payroll clerks don't really know what's going on with the accounting system. They just know that they have to get checks ready to be paid by a certain date so that those checks are going to be ready so that employees get paid on time. But everything that's happened so far between the source document, journal, ledger, and trial balance, up to this first trial balance, think of it as just being on autopilot. Things are just happening based upon the various areas of accounting. Now, it would be nice if we could run the entire system that way, but that's not going to work. What happens is that there's some areas that need to be adjusted, and this is when we talk about adjustments, we're talking about adjusting specific accounts based upon the accrual basis of accounting. And this is when we're going to introduce our high-level bookkeepers and our accountants to come in and start looking at what's on the ledger and making adjustments to those accounts based upon accrual accounting. Now, after these adjustments are entered into the accounting system, we then generate an adjusted trial balance. This trial balance and the adjusted trial balance are really the same thing in the terms of the formatting. It's just the timing. This trial balance comes before adjustments, and this trial balance comes in after adjustments. So therefore, we refer to it as an adjusted trial balance. Once we have an adjusted trial balance, now we can use that to generate financial statements. The financial statements include the 4 financial statements: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Those are the 4 financial statements we're going to be generating after we've gone through this level of the accounting cycle. Once those financial statements have been produced and distributed and everybody's happy, then at that point in time, we go through a closing process where we will actually enter closing entries and then generate another trial balance. Same thing as the other 2 trial balances, except this one is at a different time. This is after the closing entries. And because it's after the closing entries, we refer to it as a post-closing trial balance. Once we've come up with the post-closing trial balance and confirmed that all debits still equal credits, then we can start all over again. And it starts again with the source document, onto the journal ledger, etc., all the way down. This is what we're talking about when we're referring to the accounting cycle. So what I'm going to suggest to you now, what we're actually going to look at now is an unadjusted trial balance. So this trial balance, it says unadjusted trial balance, and I didn't word it that way, but I just called it a trial balance. That's at this level. In other words, we've had transactions go through from the source document to journals, the journals to the ledger, and then to the trial balance. But we haven't made adjustments to it because we've just kind of relied on everybody within the organization, within their individual departments of the accounting department, to process their information. So we have cash, we have receivables, supplies. I mean, this kind of looks like a full-blown adjusted trial balance, and it is, but we also need to recognize that because it's unadjusted, there's still some adjustments that need to be made to make sure that our accounting is correct and consistent with accrual basis of accounting. So the question becomes, what kinds of adjustments do we have to make? Well, there are 3 different types that we're going to be listing here. The first one is referred to as deferrals. And what this means is that we have to make an adjustment for a payment of an item or receipt of cash in advance. So let's assume that we make a payment for rent for an entire year. And let's say we pay $1,000 a month for rent, but we're paying a full year's worth of rent. We write out a check for $12,000. Now, deferral means we're not going to recognize that $12,000 as an expense. And the reason being? The reason is because we haven't incurred the expense. That payment that we made for $12,000 needs to be recognized over the 12 months in proportion to the rent. So if I write a check out for $12,000, then from an accounting perspective, I really only have $1,000 for that particular month of an expense. And then I have a prepaid for the remainder of the 11 months. And so deferrals simply mean just that. We have an adjustment for a payment of an item or receipt of cash in advance. So we paid in advance. We need to make an adjustment every month for that amount of money to be recognized as an expense every month. That's not going to happen automatically. That's not going to happen through accounts payable. That's not going to happen through accounts receivable. It's something that an accountant or a bookkeeper has to record or make the adjustments. By the same token, if I receive cash in advance from somebody for a service that I haven't provided, that's not revenue because we haven't recognized or we haven't supplied the service or the product yet. We got paid in advance. So when we do earn that revenue, that's when we're going to record it. Again, that is an adjusting entry that has to be made by the bookkeeper or accountants. Depreciation. When we buy assets, we don't write off an asset as an expense right when we buy the whole. If we pay $50,000 for machinery and equipment, for accounting purposes, that's not a $50,000 write-off. That's not a $50,000 expense. If we're going to use that $50,000 piece of equipment over the next 5 years, then we've got to take that $50,000 and find a way to recognize it as an expense over those 5 years. So an adjusting entry that needs to be made every period is depreciation. And the last one listed is called accruals. Deferrals mean we've actually received cash or paid cash and we're deferring the revenue or the expense. Accruals mean that we haven't even paid the cash, but we're going to recognize the expense, or we haven't received the cash and we're going to recognize the revenue. Those are the three categories of adjusting entries we will be reviewing. The first example is a deferral, and this is similar to what I was explaining. We have what's referred to as prepaid expenses. And a prepaid expense is an expense paid in advance. The prepaid expenses are assets because they provide a future benefit for the owner. So let's suppose Aladdin's Travel Incorporated prepays 3 months store rent for $3,000 on June 1st. On June 1st, they're going to record the actual payment. The payment is going to be a debit to prepaid rent for $3,000. By the way, this prepaid rent is an asset. The reason being is that technically, if we go back to the landlord and say, hey, I'm leaving, let's assume that there's no penalties or no requirement, no contract involved, then technically we should be able to get some of that money back, all right? And for that reason, we don't recognize it as an expense until we've used up those months and until we've stayed there for those months. So this prepaid rent is actually an asset. The cash is also an asset. So we're going to debit prepaid rent for $3,000 and we're going to credit cash for $3,000. Pay 3 months rent. So we're going to see the T account here, but I'm going to go ahead and actually pull it up using the same example so that we can see the impact to the accounting equation. So this represents the journal entry. If we look at the accounting cycle, what do we have for a source document? Maybe we have the lease or the check. Actually, the check that we wrote is the source document. The journal is the journal entry. Well, here's the journal entry. June 1st, prepaid rent, $3,000. That's a debit to prepaid rent. Cash is credited for $3,000. That's the journal entry. From the journal entry, we need to post this journal entry to the ledger. That's what it says here. From the journal, it goes to the ledger. So let's do that. So we're going to debit $3,000. We'll say that's number one because that's June 1st. Debit prepaid rent and credit cash. Now we don't have a beginning balance here, so we don't know what that beginning balance is, but we'll just go with the entries and the impact of those entries on the accounting equation. So you can see this debit and this credit is occurring. There's no way we can have this credit here unless we know we have cash. Now, this is what actually happened. This isn't an adjustment. This was actually processed by probably the accounts payable people. This is what was actually paid. This is not an adjustment. This is what was paid. So we wrote out a check for $3,000 and it was coded to prepaid rent. This happened on June 1st, but now we're looking at June 30. Now, this is the adjusting entry that has to be recorded. After we have used up 1 month's worth of rent, now, at this point in time, if we look at the balance, prepaid rent is showing a balance of $3,000. Well, that was for 3 months, June, July, and August. That's all okay up until the end of June. And now when June is done, the question is, do we still have $3,000 worth of prepaid rent? And the answer is no, we don't. What do we have? Well, we've used up June. We still have July and August. So there's 2 months of prepaid rent left. But right now, we're showing 3 months, 3 times $1,000. So now we need an adjusting entry. What's the adjusting entry? So the adjusting entry is on June 30th. We're going to recognize 1 month's worth of rent expense for $1,000. 1/3 of what we paid. The expense is incurred, so we have to make the adjusting entry. That entry is going to be dated June 30th, the end of June, and we're going to make the adjusting entry of rent expense. We're going to debit rent expense for $1,000, and we're going to credit prepaid rent to record rent expense. So this journal entry is going to be updating the 2 accounts. Prepaid rent is now going to show a balance of $2,000. Rent expense is going to show $1,000. Now, how does this work? So to post this journal entry made in the journal to the ledgers are represented by T accounts. We're going to debit rent expense for $1,000 and credit prepaid rent $1,000. After this journal entry, the balance in prepaid rent is now $2,000. Debit $3,000, credit $1,000, so we subtract $1,000 from the debit, and that leaves us a balance of $2,000. So we paid $3,000. Of that $3,000 at the end of June, $2,000 is still there in prepaid rent because we haven't incurred those expenses. But $1,000 at the end of June has been incurred, and that's recognized as an expense. Okay, so let's move back to June 2nd. So we're kind of going between what happens during the month and then the adjustment that has to be entered at the end of the month. So now let's go back to, let's say on June 2nd, Aladdin Travel paid cash of $700 for cleaning supplies. The journal entry because of that purchase. By the way, this was done by, let's say, an invoice or receipt that was received. The accountants receive it, that invoice, and enter into the accounting system this journal entry. Debit to supplies for $700 and a credit to cash for $700. Let's go see how that would look. Okay, so this occurred on 6/2. We're going to debit supplies for how much? $700. And we're going to credit cash for $700. Now this happened automatically on June 2nd. Probably an invoice came through, the cash disbursements clerk went through, wrote the check out, got it signed, sent it out. It was done automatically. So we purchased $700 worth of supplies. In this example here, I'm suggesting to you that supplies were large enough so that we considered them to be an asset. We're going to use this $700 over some time. And so when we first buy it, we consider it to be an asset. Okay? Now, on June 30th, at the end of the period, at the end of the month, somebody goes through to the supply cabinet and looks at what is there. And they say, okay, well, not everything that we purchased on June 2nd is still here, so let's see how much we still have in terms of dollars. So they count what they have and they figure out what the cost was. And it turns out that we have $400 of supplies that remain on hand at June 30th, okay? Well, you know, as people get a pencil or paper clips or whatever, they're not going to be updating the accounting records. It's just too much of a hassle. But at the end of the month, somebody goes in and counts and see what is still there. And we just did that, and it turns out we have 400. Well, we purchased 700. We purchased $700, and that's what we have in supplies, and this is supposed to represent what we have on hand. But we go and count it, and it's only $400. So we need to make an adjusting entry, an adjustment. And the way we're going to do that is we're going to take the 700 that we started off with, and we're going to subtract the 400 that is still on hand. This is what we still have. And the difference has to be what we've used up. So that difference, 700 minus 400, is going to leave us $300. So $300 is now an expense. It's been used up. It's a value. It's a cost that has no future value. So therefore, we recognize the expense and we credit supplies. We lower the supplies account. So you'll see we have $700. We're going to credit $300, and that's going to leave us a balance of $400. And then that $300 debit is going to be moved to supplies expense. So this is the journal. The ledger accounts are updated. Now, I'm going to do the exact same thing as this, except I'm showing you how it's impacted on the accounting equation, okay? So we're going to create an account called supplies expense. And on 6/30, we're going to debit supplies expense for $300. That's what we used up, $300. At the same time, we're going to credit supplies because that was part of the journal entry. We're going to credit the supplies account for $300. So what does that mean? That means the balance after that journal entry, the balance of supplies is exactly what I told you it was. It's $400. So now we know that supplies is reported accurately, because had we not made this adjusting entry, we would still show supplies at $700. But in fact, we actually used up some of those supplies, and so therefore we make an adjusting entry to account for that which has already been used. Depreciation now. Now, we're going to have a whole chapter dedicated to depreciation of plant assets. That's going to happen in the future. But in the meantime, we can still kind of, if we at least have a little understanding of what's going on, we can record the journal entries so that we have an understanding of how it's supposed to work. There's much more detail to it, but let's go ahead and at least get to a point where we can make a journal entry. So when we're talking about the purchase of plant assets, we're talking about land, building, furniture, equipment. These are purchases of items that have future value. We know they have future value because we can sell them into the future. If I buy a vehicle, it has value because I can turn around and sell that vehicle for X amount of dollars in a very, for the foreseeable future. There may be a point in time when that vehicle has no value to it. But initially, it will have quite a bit of value. When you buy it, you think of depreciation as when you buy a brand new car, drive it off the lot, it loses value. Well, that is true, but that's not the objective. That's not what we're trying to do for accounting purposes. What we're trying to do is take that original cost and allocate that cost as an expense over the useful life of that asset. So if we buy an asset that cost us $50,000 and it's going to last us for 5 years, $50,000 purchase that's going to last us for 5 years, that means we can depreciate it. Let's, as an example, we can, if we even it out, every year we write off the same amount. We're going to write off $10,000 as an expense every year. Every year we're going to write off $10,000 as an expense for 5 years. 10,000 times 5 years is going to give us 50,000. That was the original cost. So we are going to, in the accounting records, we're going to record the declining usefulness of that asset. Over time, it becomes less and less useful. We're going to spread the cost of that plant asset over its useful life. And there is one exception. The exception is land. We never depreciate land. We keep land at its original cost. We keep land at its original cost. We don't adjust it for depreciation. All right, so the example here, on June 3rd, Aladdin Travel purchased equipment on account for $24,000. They purchased equipment on account for $24,000. The journal entry is going to be a debit to equipment, and they bought it on account. It doesn't tell you that, but I can see that now by looking at the journal entry. They bought it on account. That means they credited accounts payable for $24,000. So that June 3rd entry will be recorded in the accounts. We're going to create an account called equipment. and we're going to create an account called accounts payable. So keep it in line with the accounting equation. Assets, the purchase of equipment. Well, if we buy a piece of equipment, that is an asset, and we're going to debit it for $24,000. So the equipment is debited for, this is the journal entry, here's the journal, and then we're going to take those numbers and post them to the ledger, and the ledger are represented by T accounts here. So this occurred on what date? June 3rd. So June 3rd, $24,000 debit. The corresponding credit, the credit is going to go to accounts payable, and that's going to be a credit of $24,000. Okay, so the debit is to equipment. That is an asset. That's under the asset section of the accounting equation. And then accounts payable is a liability, so that's listed here as a liability, $24,000 on June 3rd. Now, that's not an adjusting entry. That's what was just recorded automatically through the accounting system. At June 30th now, we need to make an adjustment because some of this asset has actually depreciated. As we're using it up, it's depreciating. And we're taking that $24,000 cost and allocating that cost as an expense over a specified period of time. So how is that going to work? We're going to use what's referred to as, for now, we'll learn much more and different ways of doing this in the future, but for now, we're going to use what's called straight line depreciation. We're going to take the cost and we're going to divide the cost of the asset by its useful life. Aladdin Travel Incorporated equipment, that's going to be the cost is $24,000, and we're going to divide it over its useful life. Let's say, for example, we think it's going to be useful for 5 years. We'll take $24,000, we'll divide it by 5 years, and each year we're going to depreciate it $4,800. So $4,800 per year. But in this case, we bought it at the beginning of June, and all we really want to do is recognize 1 month's worth of depreciation. So we'll take that $4,800 per year and we'll divide it by 12. So $4,800 divided by 12 gives us $400 per month. So every month when we're updating the books, we're going to record an adjusting entry for depreciation. The adjusting entry is going to be represented by a debit to an account called depreciation expense, $400. And the credit is going to go to an account called accumulated depreciation for $400. Okay, so a couple of things are going on here. First of all, we're recognizing the expense. We purchased equipment originally. If we go back to our journal entry, the equipment is now sitting as an account called equipment. We're going to go ahead and create an account called depreciation expense. Well, depreciation expense goes under equity, the equity section. That would make sense because expenses go under the equity section. And if you think about it from a supplies perspective, when we wanted to reduce supplies, we just credited the supplies account. So looking at supplies, we started off with 7, we credited for 300, and our balance was 400. And then we took that 300 and moved it over to supplies expense. All right, well, you might start to think right now, and I'm very proud of you if you're thinking this way, you might start to think, okay, well, we're going to expense some of this equipment, so we'll go ahead, let's go ahead and charge the adjusting entry. Let's go 630. Let's go ahead and charge $400 to depreciation expense for that month. That's 1 month of depreciation expense. And if you're seeing this, and if you're thinking, okay, that means I need to credit my equipment for $400. And I'm going to be very proud of you if you thought of it that way. Unfortunately, it's wrong. But at least you're seeing the relationship between these other accounts that we adjusted. And you're thinking, okay, that would make sense. And if you had that thought process, that's very good. But that's not the way it's done. We're going to actually create another account called accumulated depreciation. Accumulated depreciation. If you're thinking we should credit this equipment, that would make sense because that's consistent with what we did in previous journal entries or adjustments. However, accountants don't want to lose sight of this $24,000 cost. We want to keep that in play. We want to know what the cost was of our equipment for a lot of different reasons, but just accept it for right now. We do not want to lose the integrity of the original cost. So we still have this $400 that we're depreciating. So how are we going to do this? Well, we're going to create a separate account called accumulated depreciation. Now, this is going to be an exception to one of the rules that I gave you in our previous week. We defined assets as costs that have future value. And we're in the asset section and we're saying, well, wait a minute, costs that. And we also said that assets, because they're on the left side of the equation, they typically carry debit balances. That's for sure. We said that. But the key word is typically. And that's what gets accounting to be a little bit more confusing than one might think, because there are almost always exceptions to all rules. And here's an exception. We do have an account called accumulated depreciation. And we refer to this as a contra asset. And the reason we call this a contra asset is because its normal balance is a credit balance. Its credit balance, in this case, we're going to enter a credit entry into accumulated depreciation for $400. Now, we could put it here, and that would have reduced overall assets. It would have reduced equipment, and it would have reduced overall assets. But what I'm going to suggest to you is that we want to keep this integrity of the $24,000 and create a separate account where we're going to show these credits. Now, when we prepare the financial statements, we're going to actually net the debits and the credits together so that on the financial statements, you will see that it's going to be $24,000 less the $400. And then that will give us the true cost of what we have on our books associated with this equipment. But in the meantime, we are creating a contra asset account called accumulated depreciation, and we're going to credit that account. We're going to keep the integrity of the original costs under equipment and credit the amount to accumulated depreciation. So this is the journal entry: depreciation expense, $400, accumulated depreciation, $400. Now they're adding to that specifically the equipment. I didn't do that, but when you're actually working on the entries in the textbook, you're probably going to have to include the equipment, because you can have other depreciable assets other than equipment. So we're keeping track of each one of those separately. Okay, so let's go through and let's see what how the textbook described accumulated depreciation. It shows the sum of all depreciation expense. It is the balance increases over the asset's life. The balance increases, but remember, it's a credit balance. So the balance increases on the credit side, in effect lowering the value of assets over the useful life of the asset. It is a contra asset account. Its normal balance is a credit balance. Even though it's an asset, I always told you that assets on the left side of the equation, assets typically carry debit balances, but this is going to be one exception. This contra asset carries a credit balance. Contra accounts has two distinguishing characteristics. Always has a companion account. Well, the companion account for accumulated depreciation is equipment. So these two go together. They're inseparable. And their normal balance is the opposite that of the companion account. So the normal balance for equipment is is a debit. Therefore, the accumulated depreciation for equipment is a credit. Now, if we then generate what it's going to look like on the financial statements for Aladdin Travel Incorporated, specifically for the asset section. You're going to see that land was purchased for $18,000, and I think that was in the previous chapter that we had that $18,000 purchase of land. That's the balance. We purchased equipment for $24,000. That's a debit on the books, but now we have a credit of accumulated depreciation, which in effect reduces assets. So you're going to show that on the financial statement as a reduction of equipment. So 24,000 less the 400 gives you the 23,600. So equipment less its corresponding accumulated depreciation is 23,600. This is the balance of equipment now, but we keep it separate on two different accounts. Equipment is 24,000 less the $400, and that's going to give us a balance. If we net that out, that's the 23,600. Accrued expense is a liability that arises from an expense that has not yet been paid. It's not recorded daily or weekly, but rather at the end of the period as an adjusting entry. So maybe we don't have the invoice, or maybe we have the timesheets, but we haven't entered it into the system yet. There could be a number of reasons why we have an expense here that hasn't already been entered to the normal process. Whenever that does happen, whenever we have an expense and a corresponding liability, liability is a future obligation, something that we owe. When we have a liability and a corresponding expense, then we have an accrual adjustment that has to be made. So the example we're going to get here is for salaries. Suppose Aladdin Travel Incorporated pays its employee a monthly salary of $1,800, half on the 15th and half on the last day of the month. The following calendar for June has the paydays circled. So let's assume that if the payday falls on a Sunday, which it does in this example, then Aladdin will pay it on the following Monday. Well, that's too bad. So if you work for Aladdin, you normally get paid on June 30th, but apparently you're not going to get your check until the Monday that follows. But in the meantime, Aladdin owes for those salaries. It owes that money for the salaries. So how is this all going to work for the entire month? Let's go ahead and see. So it's on the 15th and on the 30th. Let's see. The first during June, Aladdin Travel paid its employees the first half month salary of $900. On June 15th, they recognized salary expense of $900 and cash, a credit to cash for $900. They debited salary expense for $900 and they credited cash for $900. So let's go ahead and enter that into our accounting system. Okay, so we have an account called salary expense. That's under equity. It's an expense. And we made a payment on, I think it was on June 15th. The first payroll was on June 15th. And it was for $900. There's my debit to salary expense. The corresponding credit was to cash. Well, we paid it. We paid it on the 15th, so we're going to record it. It's a credit to cash for $900. Now that's consistent with the journal entry we have here. Debit to salary expense, $900, and a credit to cash for $900. That's what we booked, debit and credit. Okay, now the second half, even though it's through Sunday, June 30th, we're not going to make the payment until July 1st. But as of June 30th, we owed that money. So this is an example of money that we owe and an expense that's been incurred, but we haven't paid it yet. If we ignore it, then we're going to generate a set of financial statements that are incorrect. Those financial statements will not contain an expense, a salary expense of $900 that have been incurred. So it will be misleading to the financial statement user seeing only one payment of $900, thinking, okay, that was the expense for the month. But in fact, it wasn't just 900. It was 900 times 2, because the employees earned that money during that period of time, and now we owe it to them. And so what we're going to end up doing is make an adjusting entry as of June 30th for that last month. We're not going to pay till July 1st, but on June 30th, if we want to prepare a financial statement that is correct, we have to recognize the expense and the liability. So we're going to debit salary expense for $900. So on 6/30, we're going to debit $900 for salary expense. That's going to give us 900 times 2. That means for the month of June, we're going to have $1,800, which is correct. That is, but we haven't paid it out in cash yet, so we have to create a payable. Why? Because it's owed. We owe salary payable. We owe that money. How much do we owe? We owe the $900 that we've incurred. So the journal entry, just to review, is a debit to salary expense and a credit to salaries payable. That journal entry is then posted to the ledger, and the ledger, represented by these T accounts, shows the debit to salary expense for $900 and a credit to salary payable for $900. Now, in the previous example, we had an expense that had not been paid out. We've incurred the expense, so we recognize the expense and we recognize the payable, the liability, even though they hadn't been paid out yet. But we could also have the reverse situation where we actually have earned money that has not been recorded in the books. We call that accrued revenues, a revenue that has been earned but not yet collected. Let's take a look at an example here. Assume that on June 15th, a hotel agrees to pay Aladdin a commission of $600 for booking 100 clients into its hotel over the next 30 days. Aladdin books 50 clients in June and 50 clients in July. Aladdin will earn half a month's fee, $300, for work done June 15th through June 30th. So we have a hotel that has agreed to pay us, Aladdin, a commission. And the agreement was that we will get $600 for 100 clients. Well, we look and say, okay, well, as of June 30th, we've booked 50 clients. So we've actually earned some of that stuff. We haven't been paid. We haven't paid for any of it, but we've earned half of it because we've got a contract that says we need to book 100 clients. We've earned half of that because we booked 50 clients by June 30th. Well, if we booked it, then we better record that in our system. So what we're going to do is on June 30th, we're going to recognize a receivable that's $600 times one half, that's half of the $600. We're going to debit an accounts receivable for $300, and we're going to credit service revenue for $300. Okay, so we have accounts receivable, that is an asset. I pushed it up towards the top right underneath cash because typically accounts receivable in the listing of normal assets, it's going to be just under cash. So we have accounts receivable listed towards the top. And then we also are going to list sales under equity, and that's usually above the expenses. All right. And the amount we're going to debit accounts receivable for $300. So on the T account, $300. That's as of 6/30. And then we're going to recognize a corresponding credit, and that's going to be for $300. Debit accounts receivable, credit sales, debit accounts receivable, credit sales. And we've updated the T accounts. Okay, The next adjustment we could look at is what's referred to as unearned service revenue. We have received cash before earning the revenue, and that creates a liability. Now, we say the definition of a liability is a future obligation, something that you owe. Up until now, we've been thinking about liability as cash. You owe cash, you have to write a check out. But if you're paid in advance for a service or product, you owe the product or service. So in this example here, we actually are going to receive money in advance. We're going to recognize that money is being received, but we're also going to recognize a liability because it's a future obligation. We have to perform the service or deliver the product. So in the next journal entry, you'll see, assume Disney World Resort pays, well, that's a coincidence. Aladdin Travel, Disney World Resort. Okay, so assume Disney World Resort pays Aladdin Travel $400 monthly, beginning immediately. So they're sending a check. Disney just sends a check. Isn't that kind of nice? If it books up to 8 clients into the resort within a 30-day period. So if Aladdin Travel collects the first amount on June 15th, then it records this transaction. So this is the receipt. This is what's happening automatically. This is not the adjustment. This is the receipt. Money comes in, the cash receipts clerk receives the money, enters it into the system, and what we have is on June 15th, a debit to cash for $400 and a credit to unearned service revenue. So let's go ahead and just book that into the system. That occurred on 6/15. The debit to cash for $400. But we haven't earned any of that money yet. We haven't earned any of it. So we're going to go ahead and credit an account called unearned service revenue for the same amount of money, $400. That unearned service revenue is a liability. Okay, so that we're clear, that is not an adjusting entry. That is the normal transaction that occurred when we received the money. However, let's take a look at what has happened. During the last 15 days of the month, Aladdin Travel booked 4 clients at the Disney World Resort to earn $1/2 of the $400. So we received $400 in advance, right? But now we've earned half of that. So at the end of the month, we have to now record a journal entry to adjust unearned service revenue and recognize the revenue. The debit is going to be to unearned service revenue. That's going to be the debit on June 30th for $200. And the credit's going to go to service revenue, June 30th, $200. So the debit credit, pay little attention to the previous entries here. It's as if they carried over from the previous chapter, which in fact is going to be accurate. But since we didn't know what these entries were, we're not messing with them. We're just making the adjusting entries. So this and this is what we're going to record. Now let's go ahead and see how that would look on the accounting equation. We're going to debit $200 as of 6/30. Oh, I had messed up. This should be, the $400 should be dated June 15th. So I apologize. That should be June 15th. So when we received the money, we debited cash and we credited unearned service revenue. That's dated 6/15. However, the adjusting entry on June 30th is a debit to unearned service revenue for $200 and then a corresponding credit to sales for $200. Debit, credit. That's exactly what happened on the journal entry, debit, credit. Okay, so the next couple of slides, well, this slide shows how the relationships between the accounts will occur. Prepaids are first recognized as a debit and later then are reduced and recognized as an expense. Unearned revenues are first recognized as a liability and increased, but then they're reduced, and then we recognize the corresponding revenue. For accruals, expenses are recognized immediately along with the payable. That's what happens first. And then at a later point in time, when the payments are made, we're going to reduce the payable, and then we're going to recognize the reduction of cash. Accrued revenues, we're going to recognize the receivable and a corresponding revenue before the transaction actually occurs. Then when we actually receive the cash, we're going to recognize the cash and we're going to reduce the receivable. So in the end, if you really pay attention, cash is going to be credited. This is a temporary holdings place, prepaid, then it's reduced, and ultimately it will become an expense. But the timing is everything. A prepaid expense means that we've paid some of these expenses in advance, and we recognize the expense when they've incurred. So timing is everything. Same with unearned revenues. We receive the cash, but it's not revenue up until ultimately, after it's all said and done, the money's going to sit in the cash account, and eventually it will be revenues, but it's going to be revenue in the periods in which they have been earned. Same thing with accruals. The summary of the adjusting process is there are two purposes of the adjusting process. One is to measure income. So adjust income, whether it's revenue and expenses, adjusting those accounts so that we have a proper understanding of how much money was actually made during that period of time. And then update the balance sheets. Example, supplies. What do we have at the end of the year that's adjusted to that? Prepaids. What is actually prepaid? We adjusted. Equipment, adjusted. Therefore, every adjusting entry affects both the following: revenues or expenses to measure income, and assets or liabilities to update the balance sheet. Here's a summary of all the adjusting entries. You can refer to that and study it. By the way, there's another entry that we can make here. An income tax accrual. At the end of the period when we finish, let's say, for example, as of June 30th, if Aladdin Travel is actually making money, then it incurs a liability for income taxes. It's going to owe some, and the appropriate thing to do is to recognize the expense and the liability associated with income tax in the period in which it's incurred. So now that we know that we've made a little bit of money through Aladdin Travel, we can now recognize and understand that we have an income tax of expense of $600. So we're going to make that adjusting entry as well at June 30th. So at June 30th, we're going to debit income tax expense for $600, and we're going to credit income tax payable for $600. I'll go ahead and record those. Okay, so we debit income tax expense for $600. That's dated June 30th. And we're going to credit income tax payable for $600 for the same period, same date. Here's the journal entry. These are the ledgers represented through the use of T accounts. Okay, so here are all the adjusting entries that we've just made. I think we got them all. 1, 2, 3, 4, 5, 6, 7. 7 adjustments. This was the information used to make the adjusting entries. And now I showed you step by step how it was working on here, but lo and behold, they're all right here: assets, liabilities, and stockholders' equity. And so all the adjustments were made through here, and we have updated balances. So the first was A, the first adjusting entry was $1,000 to rent expense and a credit to the prepaid rent. That's A, that was the first one. B was supplies, $300 credit to supplies. B, supplies expense. It's the same thing what we did on the spreadsheet that I was using The difference is that we have some balances here that were already on the accounts that I didn't account for. And so now this is one to study where you have a more complete picture of what has occurred. Okay, let's go back to the accounting cycle. Just to review, source documents, these are happening automatically. Invoices arriving, invoices being issued, timesheets being processed, cash receipts, disbursements, all those are automatically. And the accounts receivable, accounts payable, cash disbursement, all these clerks, payroll clerks, all of them are processing information automatically. The journals are being created automatically. The update of the ledgers are being done automatically. And then we have a trial balance. In fact, that's what we actually did in the previous chapter, chapter 2. We created a trial balance. What we've been studying right now is that we have made adjustments. These adjustments have now been entered into the accounting system, onto the ledgers. But before we go any further, we're going to create what's referred to as an adjusted trial balance. So the adjusted trial balance summarizes all accounts and their final balances after all the adjusting entries have been journalized and posted. Just remember, the objective of a trial balance is to make sure that debits equal credits. Now, there is, or was, I should say, a mechanism that used to be used way back in the day called a trial balance worksheet. And what you had was, before any of those adjustments were made, you created the original trial balance. This is the trial balance before any adjustments. And before any of those adjustments, these were given. We didn't have them when we were working through, so it's not something that you missed. But now we have them. Here were the balances before any adjustments. So they took up 2 columns in this worksheet. And then, back in the day, before computers and all that, adjustments were recorded in this trial balance worksheet. So as an example, A was a credit to prepaid rent, and then a debit to rent expense. See that? Credit, debit. And then, back in the day, we would then come up with an adjusted trial balance using this worksheet based upon the adjustments to the accounts. So prepaid rent was a debit. Now we're going to reduce it as a credit, and we have an adjusted balance. And so this gives you a feel for how it used to be done back in the day. And it also shows you where these accounts are going to be going. Well, the way they are listed, the accounts from cash all the way down to common stock will be included in the balance sheet. Retained earnings is going to go to the statement of retained earnings, along with dividends that have been recorded. Those are going to go also into the statement of retained earnings. Revenues and expenses are going to be listed on the income statement. These balances on the adjusted trial balance will carry over to the financial statements. Well, that's consistent with what I explained here. After we've made the adjustments, we've gone through the cycle, we create an adjusted trial balance. That's here. Debits equal credits. You see that? Debits equal credits. Now from here we can create financial statements.